Hello everyone, welcome to our special coverage of Asia's financial markets, where today's headlines reveal a fascinating tale of two economies moving in opposite directions. Today, on Friday, December 5, 2025, Asia's financial markets told two very different stories. While the region is often seen as a single economic powerhouse, the reality is far more nuanced, with each country responding to its own unique set of challenges and opportunities. In India, the stock market surged with optimism as investors cheered positive economic signals and policy moves. Meanwhile, in Japan, caution and anxiety took over, with traders reacting nervously to the latest developments. This split was no accident. It was all about central bank decisions. The choices made by these powerful institutions can set the tone for entire economies, influencing everything from job growth to the cost of living. Think of central banks as drivers on a busy highway. India's pressed the accelerator, fueling growth and risk-taking, while Japan's hovered over the brakes, signaling caution and restraint. In Mumbai, the Reserve Bank of India's bold move to lower interest rates sparked a rally in the Nifty 50 index. Investors saw this as a green light for expansion, leading to a wave of buying and renewed confidence in the market's future. In Tokyo, however, rumors of a Bank of Japan rate hike sent the Nikkei 225 tumbling. The mere suggestion of tighter monetary policy was enough to trigger a sell-off, as investors worried about higher borrowing costs and slower growth. These contrasting moves show how central bank policies ripple through markets and affect everyone, not just big investors. From professional traders to everyday families checking their savings, the impact is felt across society. In this episode, we'll break down what the RBI did to boost India's economy, why Japan's market stumbled, and how U.S. economic data loomed over both, adding another layer of complexity to the day's events. The global financial web means what happens in one country can quickly impact another. A decision made in Mumbai or Tokyo can send shockwaves through markets in New York, London, or Shanghai within minutes. Today, we'll help you see those connections more clearly, exploring how local decisions create global consequences. Let's dive in and unravel the story behind Asia's divergent financial paths.
Let's start with India's good news. In a move that caught the attention of markets and businesses alike, the Reserve Bank of India has taken a significant step to support the country's economic momentum. The Reserve Bank of India cut its main interest rate by 25 basis points to 5.25%. While that might sound like a small adjustment, it's actually a powerful signal to the entire financial system. Even a modest rate cut like this means borrowing just got cheaper for everyone, from large corporations planning expansions to families looking to buy their first home or car. It's a move that can ripple through the economy, making credit more accessible and encouraging spending and investment. The Nifty 50 index jumped as investors cheered the move. Stock markets often react quickly to such policy changes, and this time was no different. The optimism was visible on trading floors across the country. Why cut rates? The main goal is to fuel economic growth. Lower interest rates mean cheaper loans for both businesses and consumers, which can lead to more investments, job creation, and higher consumer spending. For small businesses, this could be the difference between launching a new project or putting it on hold. With inflation easing in recent months, the RBI had the flexibility to act without worrying about prices spiraling out of control. This careful balancing act is crucial for maintaining economic stability while still encouraging growth. The central bank even raised its growth forecast, which sent another strong message to markets and businesses that the outlook for the Indian economy is improving. This further boosted confidence among investors and entrepreneurs. Cheaper borrowing and a brighter outlook are music to investors' ears. It's not just about numbers on a screen. These changes can impact real lives, from job seekers to business owners. The RBI's message is clear. We're backing growth, and businesses can thrive in this environment. When the central bank signals support, it often leads to a wave of optimism and new opportunities. That's why the market responded so quickly. Investors and companies alike are eager to seize the opportunities that come with lower borrowing costs and a supportive policy environment. A clear policy move, a clear market reaction. The RBI's decision has set the stage for renewed optimism and growth in India's economy, and all eyes are now on how this momentum will shape the months ahead. How does a rate cut boost stocks? It's a question that sits at the heart of India's economic momentum. When the Reserve Bank of India lowers interest rates, it sets off a chain reaction across the financial landscape. Suddenly, borrowing becomes cheaper for everyone. From large corporations to small businesses, and even individual consumers. This single move can have a profound impact on the entire economy. Lower rates mean companies pay less on loans, freeing up cash for expansion or higher dividends. With reduced interest expenses, businesses can invest more in new projects, hire additional staff, or even upgrade their technology. This extra liquidity often translates into higher profits, which in turn can be shared with shareholders or reinvested for future growth. Profitable companies attract investors, pushing share prices up, hence the Nifty's rally. As more investors flock to the market, the demand for shares increases, driving prices even higher. This creates a positive feedback loop, where rising stock prices further boost investor confidence and encourage even more participation. Lower rates also make savings accounts less attractive, nudging people towards stocks for better returns. With traditional savings yielding less, individuals start seeking alternatives that offer higher growth potential, and the stock market becomes a natural choice for many. Consumers benefit too. Cheaper mortgages and loans encourage spending on homes, cars, and appliances. Lower EMIs mean families can afford bigger purchases, and businesses see increased demand for their products and services. More spending means more sales for businesses, fueling optimism. This surge in consumer activity not only boosts company revenues, but also creates new jobs and opportunities, further strengthening the economy. The RBI's move was both a financial and psychological boost. It signaled confidence in the economy's future and reassured markets that growth is a priority. It told businesses to invest, consumers to spend, and investors to expect growth. The message was clear. Opportunity is knocking, and now is the time to act. All these factors combine to create the perfect recipe for a stock market rally. The synergy between lower rates, increased spending, and rising investor confidence set the stage for sustained economic expansion. Central bank actions have real, immediate impact. They don't just move numbers on a chart. They shape the decisions of millions, fueling India's growth engine and setting the pace for the nation's future.
Now to Japan, where the mood flipped. The Nikkei 225 dropped 1.5%, erasing the week's gains. Why? Speculation that the Bank of Japan might finally raise interest rates after years of ultra-low policy. For decades, Japan fought deflation with near-zero rates, making borrowing cheap. Investors built strategies around this free money. But hints from the BOJ and media reports of a possible December hike sparked anxiety. The threat of higher borrowing costs and the end of an era sent investors rushing to sell. Why did the Nikkei react so sharply? Japan's low rates fueled the global yen carry trade, borrowing yen cheaply to invest elsewhere. A rate hike would make borrowing yen pricier, forcing investors to buy back yen, strengthening its value. A stronger yen hurts exporters like Toyota and Sony, making their goods more expensive abroad. Higher rates also mean bond prices fall, risking losses for banks and pension funds. Even a hint of change shakes the system. Markets fear the unknown. The BOJ must tread carefully to avoid a financial shock. The sell-off shows just how sensitive markets are to policy shifts.
Even with big news in Asia, traders watched Washington for US inflation data, the PCE index. Why? The US is Asia's biggest customer. Strong American demand boosts Asian exports and profits. If US inflation is high, the Fed keeps rates high, attracting global capital and pulling money out of Asia. That can weaken Asian currencies and pressure their markets. If US inflation falls, the Fed might cut rates, easing pressure worldwide. The PCE report is a key clue for investors everywhere. Asian markets move in sync with US economic signals. In today's world, no market is an island. A ripple in the US can become a wave in Asia. That's why everyone was watching. The real game is guessing the Fed's next move. Recently, the Fed's rate hikes made borrowing in dollars expensive, slowing global markets. Now, investors are hoping for rate cuts. When and by how much? A US rate cut would weaken the dollar, making Asian exports more competitive and easing debt burdens. Recent US data, like falling jobless claims, hint at a cooling economy, just what the Fed wants. Investors want a Goldilocks scenario, not too hot, not too cold. Every US data point is scrutinized for clues about the Fed's timing. Asian traders held back, waiting for the PCE report before making big moves. The Fed's shadow looms over every trading decision in Asia. Timing is everything.
Beyond India and Japan, Asia's markets were a patchwork of gains and losses. China's main indexes were flat, reflecting uncertainty about its recovery. Hong Kong edged down, while South Korea's Kospi rose 0.7% on tech optimism. Australia's market was steady, balancing global growth worries with domestic stability. Singapore slipped 0.4%, wary of global policy shifts. Each country faced its own challenges. No single trend dominated. The day's trading showed Asia is a diverse region, not a monolith. Local factors matter as much as global ones. What's the big lesson from today's Asian markets? Central banks have immense power over markets and your investments. In India, a rate cut sparked confidence and a rally. In Japan, even talk of a hike triggered a sell-off. Markets react not just to actions, but to expectations. Whether you're an investor or saver, central bank moves affect your money. The events of this day were a real-world lesson in market psychology. We saw a market cheer a rate cut, fear a rate hike, and wait for US signals. Understanding these forces helps you navigate the financial world. Stay informed, and you'll be ready for whatever comes next.